Welcome back to TradeMindGames. I'm Nathaniel. Today we're exploring what many consider the definitive work on trading psychology, Trading in the Zone by Mark Douglas. This book has fundamentally transformed how traders understand the relationship between market analysis and consistent performance.
And I'm Elliot. You know, Nat, what strikes me most about Douglas's work is how he systematically dismantles the common misconception that trading success comes primarily from market analysis. In my 2 decades of trading, I've watched countless talented analysts fail to translate their technical expertise into consistent profits. Douglas explains exactly why this happens.
That's such a crucial point, Elliot. Douglas identifies this fascinating paradox where trading appears deceptively simple because you don't need any special skills to place a winning trade, yet achieving consistent success is extraordinarily challenging. Could you break down why this paradox exists?
Absolutely. Douglas explains that this paradox emerges from the fundamental mismatch between how our minds naturally process information and how the market actually works. Our minds are wired to seek certainty and avoid pain, but the market operates in probabilities. When you combine this with the unlimited potential for profit and loss, you create what Douglas calls a psychologically toxic environment for most traders.
Speaking of market behavior, Douglas makes this brilliant distinction between analysis and probabilities that completely transformed my own trading. After years of managing institutional portfolios, I kept seeing the same pattern. Traders with incredible analytical skills still struggling with consistency.
That's because, as Douglas explains, technical and fundamental analysis only tell us what might happen. They identify potential edges, but the real challenge lies in how we handle the inherent uncertainty of those edges. Look at the October 1987 crash. Even traders with perfect technical setups got destroyed because they couldn't accept that their analysis, while sound, didn't guarantee the outcome.
Exactly. Douglas breaks this down into what he calls the 5 fundamental truths about the market. The first and most challenging is that anything can happen. I remember when I first read this. It seemed obvious, yet when I examined my own trading decisions, I realized I was constantly acting as if I knew what would happen next.
This gets to the heart of what Douglas means by thinking in probabilities. It's not just intellectual understanding, it's about developing a completely different mental framework. Take the 2008 financial crisis. Even after Bear Stearns' collapse, many traders couldn't accept the possibility of Lehman Brothers failing because it didn't fit their mental model of how markets should work.
That's a perfect example of how our beliefs can blind us to market realities. Douglas argues that these beliefs create what he calls a psychological gap between our expectations and market behavior. How do you see this playing out in your institutional trading experience, Elliot?
The clearest example is how professional traders handle risk. Many claim they accept risk, but as Douglas points out, there's a profound difference between intellectual acceptance and true emotional acceptance. I've seen entire trading desks blow up because they confuse position sizing with risk acceptance. They think because they're using stops, they're managing risk, but they're actually trying to avoid the emotional experience of being wrong.
This connects directly to Douglas's second fundamental truth. You don't need to know what's going to happen next to make money. He uses this brilliant analogy comparing successful traders to casino operators. Could you elaborate on why this comparison is so powerful?
The casino analogy is crucial because it illustrates how probability-based thinking actually works in practice. Casinos win consistently not because they predict individual outcomes, but because they understand that over a large sample size, their edge will generate profits. They maintain the same disciplined approach regardless of whether they're having a winning or losing night.
And that's exactly where Douglas introduces his third fundamental truth. There's a random distribution between wins and losses for any given set of variables that define an edge. In my experience managing trading teams, this concept is often what separates consistently profitable traders from those who struggle.
Precisely. Think about how this played out during the 2015-2016 crude oil decline. Traders who understood the random distribution principle maintained their systematic approach through the entire move from $100 to $26. Those who didn't kept trying to pick the bottom, convinced each bounce was the real reversal.
Douglas emphasizes that this understanding must exist at both an intellectual and emotional level. He outlines this fascinating psychological framework where we have to train our minds to stop associating current market conditions with past experiences. It's what he calls staying in the now moment.
The challenge is that our minds are literally wired to make these associations. When Douglas talks about the pain avoidance mechanism, he's describing a fundamental aspect of human psychology that works well for survival, but works against us in trading. This is why even experienced traders can freeze up during volatile market conditions.
Let's break down his fourth fundamental truth, that an edge is nothing more than an indication of a higher probability of one thing happening over another. This seems to be where many traders get derailed, trying to turn probability into certainty.
Absolutely. Consider the dot-com bubble of 2000. Fundamental analysts had a clear edge showing tech valuations were unsustainable. But many blew up their accounts because they couldn't accept that an edge doesn't guarantee when the market will align with that reality.
This brings us to Douglas's practical methodology for developing what he calls a trader's mindset. He outlines this fascinating exercise requiring traders to take at least 20 trades following their system without deviation. What's your take on this approach?
It's brilliant because it forces traders to confront their psychological barriers in real time. When I implement this with trading teams, we see the same pattern Douglas describes. Initial resistance followed by a profound shift in how they perceive market action.
And this connects directly to his fifth fundamental truth, that every moment in the market is unique. Douglas argues that this uniqueness means we must approach each trade as its own distinct event, regardless of what happened in our last trade or what we think might happen next.
This is where his concept of creating a belief in consistency becomes so powerful. He's not talking about positive thinking or self-help platitudes. He's describing a systematic process of rewiring how we interpret market information. The 7 principles of consistency he outlines provide a practical framework for this transformation.
Let's walk through these principles for our listeners. The first is objective identification of edges. Douglas is very specific about what this means in practice. It's not just about having a methodology, but about removing emotional contamination from our market analysis.
Right. The second principle, predefining risk, is equally crucial. Douglas argues that if you haven't defined your risk before entering a trade, you're essentially saying you know what's going to happen next, which contradicts the fundamental nature of market action.
The third principle, complete acceptance of risk, is particularly fascinating because it gets to the heart of why many technically proficient traders still struggle. Douglas argues that true risk acceptance means being completely at peace with any outcome before you enter the trade.
This connects directly to the fourth principle, acting on your edges without reservation or hesitation. During the 2020 March crash, many traders had clear edges but couldn't execute because they hadn't truly accepted the risk. Their hesitation cost them the opportunity to participate in one of the most significant market movements of the decade.
Douglas's fifth principle, paying yourself as the market makes money available, addresses another common challenge I've observed in professional trading environments. Traders often struggle more with managing winners than managing losers.
This is where his concept of systematic profit-taking becomes crucial. Douglas argues that since we can never know the ultimate extent of a market move, we need a mechanical approach to capturing profits. He suggests scaling out of positions in thirds, which allows us to maintain exposure while securing gain.
The sixth principle, monitoring your susceptibility to making errors, introduces what Douglas calls the observer's perspective. It's about developing the capacity to watch your own behavior without emotional judgment. How do you implement this with your trading?
I've found that maintaining a detailed trading journal, as Douglas suggests, is essential. But not just recording trades, documenting the thought process behind each decision. The 2008 crisis taught me that understanding why we make certain decisions under stress is as important as the decisions themselves.
This leads us to his seventh and final principle, understanding the absolute necessity of these principles. Douglas emphasizes that this isn't just about intellectual understanding. It's about developing unshakable beliefs that govern our trading behavior.
What's particularly powerful about Douglas's approach is how he connects these principles to the three stages of trader development: mechanical, subjective, and intuitive. Most traders try to jump straight to intuitive trading without building the psychological foundation.
Let's break down these stages for our listeners. The mechanical stage is about developing consistency through strict adherence to rules, regardless of what you think or feel about the market.
Exactly. The subjective stage only becomes possible after you've mastered the mechanical aspects. This is where you can start incorporating discretionary elements while maintaining the probability-based mindset Douglas describes.
And the intuitive stage, what Douglas calls trading in the zone, emerges naturally from this foundation. It's not about abandoning rules or analysis, but rather achieving a state of enhanced perception where you're fully aligned with market action.
The key insight here is that you can't force yourself into the zone. As Douglas explains, it's a state that becomes accessible only after you've thoroughly integrated the 5 fundamental truths and 7 principles into your trading psychology.
As we wrap up today's deep dive into trading in the zone, what would you say is the most crucial takeaway, Elliot?
For me, it's Douglas's central message that consistent trading success isn't about finding better indicators or analysis. It's about developing a probability-based mindset that allows you to fully execute whatever methodology you choose. This book provides the roadmap for that transformation.
Next week's episode is going to be particularly exciting, as we'll be analyzing Jack Schwager's Market Wizard series, where we'll see how many of Douglas's principles are reflected in the interviews with some of the world's most successful traders.
Indeed, the psychological insights from Market Wizards complement Douglas's framework beautifully. We'll explore how legendary traders like Paul Tudor Jones and Bruce Kovner embody these probability-based thinking patterns we've discussed today.
If you found value in today's breakdown of trading in the zone, make sure to hit that like button. It really helps our content reach more traders who could benefit from these insights. And don't forget to ring that notification bell to stay updated on our weekly trading psychology deep dives.
We'd also love to hear about your experiences with Douglas's concepts. Share in the comments below how you've dealt with the challenge of maintaining a probability mindset in your trading. Your insights might help fellow traders on their journey.
And if you haven't already, hit that subscribe button to join our growing community of mindful traders. Remember, as Douglas teaches us, consistency isn't about being right all the time. It's about thinking in probabilities.
Thank you for joining us on TradeMindGames. Until next week's episode, trade well and trade mindfully.